Welcome to this explainer. Today, we're diving into a high-stakes reality, something that affects literally almost all of us, but, we kind of just ignore it until it's absolutely too late. We're talking about transparent information and fair advice in the insurance sector. We're going to unpack how unclear policies, misleading sales tactics, and buried clauses aren't just annoying for us as customers. They are actually massive, quantifiable risks for the companies themselves.
Okay, let's dive into this, because the consequences here, they are incredibly severe. I mean, when we buy insurance, we're essentially buying a safety net, right? But what happens when that safety net is just riddled with holes, completely hidden in the fine print? The ripple effects of those ambiguous policies can be devastating. We're talking directly leading to denied claims, enormous out-of-pocket expenses, and in the absolute worst-case scenarios, literal personal bankruptcies. It basically transforms a product that's meant to give you security into a total trap.
And look, the industry is keenly aware of this. Take a listen to this quote straight from the SASB Sustainability Accounting Standards. Unclear insurance policies, ambiguous product terms, and potentially misleading sales tactics may erode brand reputation. Financial regulators are placing a huge emphasis on consumer protection right now, exactly to prevent this kind of erosion. It's not just about doing the right thing. It's about preserving shareholder value and institutional trust.
Section 1. The Transparency Trap.
So let's look at the actual mechanics of this issue to understand the sort of dual nature of the insurance industry. On one side, you've got the ideal state, right? The fundamental societal purpose of insurance is alleviating unexpected economic shocks. It's there to protect you if you get sick, if you're in an accident, or if a natural disaster hits. But then, on the other side, we see the really dark reality of mis-selling. When dissatisfied customers avoid getting the coverage they actually need because they've been burned by bad practices before, or say a hidden clause denies them a crucial payout, it triggers dire negative financial outcomes. And for the companies, it invites massive regulatory fines.
So how do we actually measure this? How do we know for sure if a company is falling into this trap? Well, investors and analysts actually use a highly specific set of SASB metrics as a sort of forensic toolkit. These metrics track the fallout from the transparency trap. They take the unquantifiable, things like reputation or customer trust, and turn them into hard, undeniable data points that show us exactly how an insurance provider is treating its policyholders.
Section 2. Counting the legal costs.
Now, what's really interesting about this is how we track the actual monetary fallout of all this bad advice. We look at metric FNN 270A.1. Think of this as a checklist of what went wrong in our hypothetical case study. When an insurance company fails to communicate clearly, it inevitably leads to legal disputes. This metric requires companies to report their monetary losses from a whole spectrum of bad behavior. We're talking false advertising, burying critical exclusions in the small print, aggressively marketing really complex products to vulnerable groups. It also tracks the fallout from hidden fees, mis-selling products that just do not fit the customer's risk profile, and of course, overcharging clients.
But here's a really fascinating detail about how this data is calculated. This metric tracks the total monetary losses from civil judgments, regulatory penalties, and even criminal restitution. However, and this is key, it deliberately leaves out the money the company actually spends defending itself. Why? Because the focus here is strictly on the penalty for the harm caused to the consumer, not the cost of their corporate legal team. It gives us a pure, unfiltered number of the financial damage that results directly from a lack of transparency.
And companies can't just, quietly pay a fine and sweep it under the rug. No way. The standards require entities to explicitly disclose the nature of the loss and, most importantly, any corrective actions they've implemented. Have they completely overhauled their management structure? Did they institute new sales training protocols? Have they updated their technology so customers actually understand what they're buying? This ensures that the penalty actually drives systemic, real change within the organization.
Section 3. Tracking customer dissatisfaction.
Of course, a lawsuit is just the final, most explosive stage of customer anger, right? Long before it ever reaches a courtroom, we use metric FNN-in27A.2. That's the complaints to claims ratio. It's defined as the number of confirmed consumer complaints received per 1,000 claims filed. Think of this as a really vital diagnostic tool. It acts like an early warning system, uncovering systemic mis-selling, poor communication, or maybe a totally broken claims process. If this ratio starts climbing, well, it means the transparency trap has been sprung.
So the crucial point is how we actually define a complaint.
We aren't just looking at, angry tweets or frustrated phone calls to a call center. Instead, this metric compares total claims filed against complaints that have been specifically upheld by an independent external dispute resolution organization, like a government regulator or an ombudsman service. This filters out all the noise. It ensures we're only looking at legitimate, validated grievances where an independent third party literally looked at the policy, looked at the customer's experience, and said, yep, the insurance company was absolutely in the wrong here.
Section 4. The value of retention.
Once trust is broken and those complaints are validated, we reach the ultimate business consequence of the transparency trap, which is a mass customer exodus. This brings us to metric F&E in 270A.3, which tracks the customer retention rate. In the insurance industry, entities compete fiercely on price, financial strength, and crucially, brand reputation. When that reputation starts to erode because of ambiguous terms and unfair advice, customers churn. They just leave. Tracking the exact percentage of customers who actually choose to renew their policies versus those who flee to a competitor, that is the ultimate litmus test for whether a company is truly serving its clients' best interests.
Now, to make sure this metric is actually fair and accurate, there are a few very logical exclusions. Companies aren't penalized in their retention rate for dropping customers who, say, commit fraud, or who simply stop paying their premiums. They're also not penalized for attrition in employer-sponsored plans. So, for example, if an employee leaves their job and therefore leaves the company's group life insurance plan, that's not considered a failure of the insurance brand. Isolating these factors ensures the retention rate accurately reflects purely voluntary customer satisfaction.
Section 5. Communicating with clarity.
Let's move to our final section and see how this all builds toward a solution. We've seen the traps, we've seen the legal costs, and the customer churn. Now we look at metric FN in 270A.4, which mandates a description of exactly how companies inform their customers. A truly transparent company must operate clearly across this entire four-step lifecycle. First, suitability, ensuring the product actually matches the customer's real risk profile. Second, cost structure, making all those fees painfully obvious. Third, coverage terms, clearly defining the scope and the limits. And fourth, the claims process, ensuring the customer knows exactly what to do and who the responsible adjuster will be when disaster actually strikes.
Digging a little deeper into that communication piece, companies are required to explicitly detail any unique policy exclusions. A great example from the source material is an anti-concurrent causation clause, which, is a very complex piece of legalese that can basically entirely void a payout if two disasters happen to hit the exact same time. If an insurer has that buried in their policy, they must make it crystal clear to the buyer. They also have to detail the mechanisms they use to communicate, like online portals or hotlines, and identify the responsible staff at every single stage of the customer journey. This ensures regulatory compliance and honestly just ethical industry best practices.
And that brings us to the end of our case study. So I'm going to leave you with this final, somewhat provocative thought. Does your own insurance provider actually meet these rigorous standards of transparency? Do you truly understand the exclusions hidden in your own policies? As we've seen today, transparent terms aren't just a nice-to-have feature. They are an absolutely essential shield that protects both the long-term shareholder value of the company and, ultimately, your own financial future. Thanks so much for joining me for this explainer, and remember to keep asking those tough questions.